Hello and welcome. In the first lesson, we learned that the balance sheet is two sides that must always have the same level. On one side we have assets and on the other we have liabilities and equity. The level on each side can change, but the levels of the two together must always be the same. Then, we gave an example where you start a shop for building materials and provide your own land. Since this is your own land, the source of this asset is equity and it increases. Then, your friend Mr. Melvin becomes your partner and builds a shop and provides some cash. Since Mr. Melvin became a partner, it means he became an owner just like you. So the source of additional increase in assets is still equity. Then you bought inventory for cash, so you just converted one type of assets for another and the two levels remained the same. Afterward, you bought additional inventory on account. So your assets increased and the source of this increase is liability because you have to pay this money later on. Each bag of cement costs you 100. So if you sell 2, your direct cost would be 200. You are up in business and you make your first sale. You sell 9 bags of cement for 1,500 in cash. This increases your assets. Each bag costs you 100 and you sold 9 bags. Since you don't have these bags anymore, we have to remove their value from the inventory. So your assets decrease by 900. You also incur cost of 100 for delivering the cement sale. And you pay this amount from your cash balance. So assets again decrease by 100 and the net effect of this transaction is an increase in assets by 500. This 500 is profit. Since the profit belongs to the owners, the equity must increase in order to keep the two levels equal. People who lend you, whether they are banks or suppliers, have nothing to do with your sales, cost, profit or loss. They just care to get the money they gave you back. For example, if we consider the suppliers on account of your inventory, those represent a liability. Unless a transaction has to do with them directly, liabilities never get affected with changes in the level of assets. For example, for suppliers, we use their account only if a transaction has to do with them, as in purchasing their stock on account or paying them. Otherwise, they don't change. At this moment, the net effect of the sale transaction is reflected in our balance sheet. But is it good? Is it good to track changes of overall assets and not individual items? The problem if we only record the net result is that although the total level of the balance sheet would be correct, the representation of different assets would be wrong. For example, the value of inventory stayed the same. It shows that we have more than we actually do after the sale. Our inventory balance should be reduced by 900. The same applies to our cash. Its balance should increase by 1,400. To overcome this problem and have correct figures, in accounting we record the effect of each of these 3 steps individually. Let us see why this is important and very useful. Let's use some numbers so the concept becomes clear. We start with a new balance sheet. We have the assets and their total, and we have liabilities and equity and their total. You provided your own land to the business. The land value is 20,000. We add an item to assets and call it land. Since it's your money, your equity increases. Let's create an account and call it your investment. Mr. Melvin provided the shop. The shop cost was also 20,000 and Mr. Melvin also invested 2,000 in cash. We add these items to our balance sheet. You bought inventory for cash. We don't have an item called inventory in our assets, so we add it. You bought 16 bags of cement for 100 each. The total value is 1,600. You paid for this inventory in cash, so your cash decreases by 1,600. And assets are still equal to liabilities plus equity. You also bought additional inventory on account. Since we already have an account called inventory in our balance sheet, we just add the value of the new inventory to the previous balance. You bought 12 bags for 1,200. We add it to the balance and the new value of our inventory becomes 2,800. Since you bought this inventory on account, you will have to pay this money later. That is, the source of this new inventory is liability. We create an account under liabilities and call it trade payables. Today is the first official day in business and you make your first sale. You sell 9 bags of cement for 1,500 and receive the amount in cash. Therefore, you add this amount to the previous cash balance. This money belongs to your business, so we have to add it to equity. But this is not an investment you made. It is not good to add it to your personal investment account. They are different in nature. The same applies to Mr. Melvin Investment. So we create a new equity account and call it what it represents. This increase in assets was due to a sale, so we call this account sales. Do we still have these 9 bags? No, we don't. So we have to deduct their value from our inventory balance. Since the cost of each bag is 100, we have to deduct 900s. By now, our assets decreased by 900 and the balance sheet is not balanced. As explained before, people who lend you money or stock don't share your profit or loss. They just want their money back. This 900 is your own cost and we have to deduct it from equity. But this is not your personal investment, your friends or sales money. It has a different nature. In the sales account, we recorded an increase in assets, an earning. Here, there is a decrease in assets. The inventory has decreased. Since it is different, we create an account under equity and call it what it represents. Cost of inventory sold. Note that the balance of this account is negative because it naturally reduces equity. Now our balance sheet is correct, but we also paid 100 in cash for delivering the sale. So our cash balance decreases by 100. Again, the owners are responsible for this cost, and we have to deduct it from equity. But can we use the account we called cost of inventory sold because it serves the purpose of reducing equity? Or would it be better to create a new account so we can track each cost separately? It is better to create a new account because tracking the different costs allow for better business control. Creating a separate account can be extremely helpful. At any point we can track the 2 costs separately. We create the new account and our balance sheet is correct. Congratulations, you made your second sale. You sold 3 more bags of cement. You sold them for 500 in cash and the delivery cost is 50, also cash. Now how do we account for this sale? We just have to repeat the previous transaction. Your cash increased by 500 and so your equity. Since we already created an account for sales, we just add the new amount to it. The cost of each bag is 100. Since you sold 3 bags, you have lost 300 worth of inventory and we have to remove this amount from the inventory balance. We reflect this decrease in assets in a decrease in equity. We just remove this amount from the equity account we called cost of inventory sold. For delivery expense, our cash reduces by 50 and so the equity. Importantly, our balance sheet is correct. But what about these new accounts that we created under equity? The accounts that we created to track your sales. Let us make them sub-accounts and group them under one main account and call it retained earnings. The net balance of these sub-accounts is the balance of this main account. You see this group of accounts? This group represents the income statement of a company. It represents all the profits or losses a company incurs during a certain period. At any point of time, it can show whether you are making profit or loss. You see, the income statement is just an equity account. The cash flow statement is no different. It is just the cash account that you already created. That's why the balance sheet is the most important concept in accounting. Following this method, where we always keep the 2 levels equal, allows us to capture the financial situation of a business at any point of time. Following this method, we apply what we call accounting principles. These principles are very useful. On the other hand, if we only track changes in the totals, we won't be able to differentiate in the value of what we own. We won't be able to tell how much cash we have unless we count. The same applies to inventory. If we go one step further and only track changes in total assets without liabilities and equity, we lose even more sight. We won't be able to tell how much we own or how much we owe other people. These accounting principles allow for a sustainable and accurate accounting system, an accounting system that provides the necessary information to manage and control a company. That's it for this lesson. I encourage you to practice your understanding with the test that can be accessed through the link in the description. Please let me know if you have any questions. I really hope this video was useful to you.